Well, first thing we need to do is get you educated. And in order to do that, we're gonna start right at the beginning. There's two main types of financial aid here, okay? There's need-based financial aid and merit-based financial aid. Merit-based aid is just what it sounds like. This is money that's given to students just based on their credentials. Need-based aid in some ways is the exact opposite, in that it does not focus on the student, but more focuses on a particular family and their financial situation. And then when we go college by college is how each of them run their individual businesses. Now, every college, when we focus on need-based financial aid, uses the same equation. This is universal. That equation is the cost of attendance minus what's called the expected family contribution. And the difference between those two is a family's eligibility for need-based financial aid. So to put them in acronyms, it's COA minus EFC equals need. Okay, now the cost of attendance, when we throw that term around, that's these scary sticker prices that we see. Right now, all these colleges that are in the 70s, okay, in terms of $70,000+ a year, and we have a fair amount of them now dozens of them. We're less concerned about that number, and we'll talk about why. We're more concerned with the other two terms. That's expected family contribution, first of all. So what that is a dollar amount that's assigned to our family. And there's three basic formulas that are used to come up with this number. There's the federal government formula, what's called the federal methodology. There's what most private schools use, which is called the institutional methodology. And the third type is what's called consensus methodology. And this is a methodology that's kind of private schools within the private school system. There's only about 25 colleges that use this consensus methodology. Tends to be the most prestigious schools. A lot of the Ivies, MIT, these types of colleges are the only ones that use the consensus methodology. And we'll talk a little bit about the differences with each. But let's get an idea for the federal government. How did they come up with this? Well, the first thing that they're gonna do is that they're gonna look at our income, they're gonna look at our assets, and they're gonna assign a dollar amount just based on those two. What it does not include is home equity. So if we are a homeowner, that is not going to be considered within federal methodology. They're just going to look at income and liquid non-retirement assets. That's another important component too. The federal government, as well as the private colleges, will not consider retirement or qualified investments and savings. Institutional methodology, so what the private schools are using, one of the biggest differences is the fact that they will include home equity. So if you are a homeowner, and for example, your home is worth $400 and you owe $200 on your primary residence, they're gonna consider that to be a $200,000 asset. So that's gonna negatively impact our family contribution. It's gonna give us a higher EFC. Consensus schools is a little bit of a hybrid in that they will consider home equity, but they will look at a lesser percentage than private colleges will, than the institutional methodology. So there's three basic formats, okay? And the biggest differences being that the private schools in general consider home equity, the public schools in general do not. So if we're clear with that, we need to know, well, what are they exactly going to take into account with this EFC? And specifically the assets, because our income is what it is.
If we understand this concept that the expected family contribution number is the most important component of that equation, what are some of the things that we can do as a family to limit that EFC, or better yet, lower that EFC? Because if we can drive down that EFC, we can drive up our need. And that results in more grants, more scholarships, and that's the goal here, okay? So one of the first things we want families to remember, by the time a family goes to complete the financial aid forms, ideally you wanna have 0 assets in a student's name, okay? The reason being is that for colleges, that's the lowest hanging fruit. Okay, that's the first place they look, and they really consider if there's any money in the student's name, that should be coming to us. They value those assets at a much higher percentage than that of parents, okay? And that's really the biggest issue. The other issue is that students, they do not have what's called an asset protection allowance, whereas parents do. Parents are able to have, generally speaking, between $25,000 and $30,000 of non-retirement assets before it even starts to come into play, okay? So it's much better to have money in a parent's name than it is a student, okay? So along those lines, a common mistake is how families report 529 money. Now, if you don't know what a 529 is, a 529 is your traditional college savings investment account. The problem is that logic would tell you, because this money is earmarked for the student's education, that it's the student's asset. And many families go ahead and report this on the financial aid forms as the student's asset. And not only would they be incorrect in doing so, but they would be killing their chances for demonstrating need-based financial aid. 529 money is a parental asset and should be reported as such on the financial aid forms. So that kind of segues into what is considered an asset. So what is considered an asset is anything that is in a non-qualified account, okay? Non-retirement savings. Anything that's in a retirement account is not held against you. 401k, an IRA, a Roth, qualified annuities, okay? That is not part of this equation. But checking savings, stocks, bonds, mutual funds that are non-qualified, non-retirement accounts, those are part of the process. So, you know, though it may seem obvious to some, we have seen families make mistakes where they include their 401k on the forms. And again, with this process, certainly less is more. How does home equity factor into this? It's going to play a big role, okay, at the private schools. And there's a common theme here in that public universities and private universities function differently. And the main difference is the fact that private schools will consider the equity in your primary residence as fair game and treat it no differently than a checking or savings account or a mutual fund or what have you. Do we think that's fair? Absolutely not. But it's important to understand that in your planning purposes. So don't be surprised that if you're a homeowner with a decent amount of equity, you're going to have two different EFCs. You'll have what's called the federal EFC, or the federal methodology. And at the private schools, you'll have an institutional EFC using the institutional methodology. Okay? So it's very important to understand this because it's going to be important on how you present your situation to these colleges. And certainly we want to position in a way that limits the equity that's shown. So if you are a family who owns their own home, is looking at private schools, I encourage you to join us for our paid course because we'll talk about the details and how we can value our home, how we value the debt on our home to shrink that equity, which in effect shrinks our EFC at the private schools and drives our need up.
So how does income factor into this whole equation? Well, again, it's one of these things where there's not too much we can do to manipulate that. It is what it is, but there's some things we should be aware of. And again, there's this major distinction between parent income and student income. And they're going to put, just like assets, more emphasis on student income. Now, students do have a protection allowance, an income protection allowance, as opposed to the asset protection allowance, which they didn't have. And that number is about $6,000. So if they make in a year $6,000 or less, it does not have any impact on the family contribution. But once they start to make anything above that, it will be factored into the equation pretty heavily. And we're more speaking to self-employed families that may pay their students a salary. Great tax strategy, but if we want to qualify for need-based financial aid, that could come and to bite us, okay? So it's something that we'll want to look at. Another thing, and a really critical point for self-employed families, and this is regardless of how your business is structured, and that is that if you have less than 100 employees, you do not report the business assets on the FAFSA. Okay, and this is a very common mistake and can be very confusing because the FAFSA is going to ask you point blank, what is the net worth of your business assets? But what it says in the fine print is that make sure you put $0 unless you have more than 100 employees. So again, we are not reporting our business assets on the FAFSA unless we have more than 100 employees. And if you have more than 100 employees, you're not watching this video anyway. Now, lastly, if we're a family that has a very high income and there's no way that we're going to qualify for need-based financial aid, another way that we can capture some value is through what we call tax scholarships. So typically, if you have a student in college, you're eligible for a $2,500 annual tax credit, but you can only get this if you make less than $180,000. Over the years, we have discovered a way to show wealthier families how they can take advantage of this tax credit in different creative ways. Now, we're not moving mountains here, but over the course of 4 years, that's still $10,000 that we're able to show them how to capture. It gets a little complex. That's why this is something we talk about in our paid course, and there's a few different ways in which we can handle it. But the big takeaway is I don't care what your financial situation is. If you're well off, if you have a very low income, there are different ways to capture value. There are different ways to complete this process in the most efficient way. We just want to show you how to do that.